Welcome back. Even as the banking result season ended with SBI, we got the global equities rout, which pushed up expectations of Fed rate hikes. And this was followed by a surprisingly hawkish monetary policy from the Reserve Bank. So at the end of it all, how are banks placed in terms of future margins, loan growth, deposit growth? For all these questions, I have with me Suresh Ganapathy, the banking expert from Macquarie Securities. Suresh, welcome. Thank you very much for your time. Let me first start with what the SBI chairman Dinesh Khara told me on Monetary Policy Day about a simultaneous fall in bond yields exactly when deposit rates are shooting up. Just listen to him. I'm coming back to you.
There's a change in the interest rate structure when it comes to the lending. A lot of loans are being priced linked to the T-bill. And today, the way T-bill is behaving, in fact, the market is actually from that perspective, as far as T-bill is concerned, it's coming down. But when it comes to the liquidity issues, that actually forces banks to go for the higher cost of deposits. In such a situation, perhaps when RBI has said that they are concerned about the interest rate movement in deposit rates, I think it's quite justifiable. But I would say that there are various sub-segments in the market and they're all getting priced differently.
Okay, Suresh, the long and the short of it is the banks are facing pressure on both sides. Irrespective of what the results were, is life getting tougher? Should we be prepared for lower margins?
Yeah, I mean, that's very clear, right? So he's saying that there is pressure on deposit rates, and you have seen obviously all these banks coming up with some special deposit schemes. And funding still remains a challenge. And even the Reserve Bank of India governor said that you have to come up with some innovative schemes to get deposit growth. So clearly, there is on one hand pressure on the funding costs, and on the other hand, obviously, you have loans which are priced off T-bills, priced off external benchmark rates and stuff. So that is also showing pressure. The latest data from the Reserve Bank of India very clearly shows, specifically when it comes to the public sector banks, the weighted average deposit rates have gone up, but the weighted average lending rates have remained flat of late. So that clearly shows that there is more margin pressures to come for the sector in the coming quarters.
Okay. So will you tone down your margin expectations even after the reports you wrote after the results? Especially now, let's start with SBI because the results came the last.
Yeah.
Are you going to bring down the margin expectations and even loan growth expectations? Because after all, the raw material has become expensive. Money.
Yeah. Look, I think, I mean, about 6 months ago itself, people obviously knew that there is pressure from the funding side, and therefore that will spill over to the lending side with respect to the ability of the banks to grow their balance sheets. So loan growth estimates have already been pared down. What I think most of the analysts, or for that matter, the market has got it wrong in our view, is the fact that we thought we have almost reached the bottom level of margins as of 4Q, but 1Q very clearly showed that margins continue to remain under pressure, and nobody expected, Latha, the LCR guidelines to come and take shape in the current format. Obviously, we know it's a draft guideline, but clearly the Reserve Bank of India is wanting to implement with effect from 1st April 2025. So before that, clearly banks will have to beef up their liquidity coverage ratios or realign, right? So either it means focus more on retail deposits or invest more in government securities, and that is the additional downside pressure to margins. So yes, across the board, for both PSUs and private sector, we do believe there will be more margin cuts coming forward in our view.
Okay. Your view on SBI itself?
We do have a self-recommendation on SBI. I think, Latha, what we are arguing here is that the ROAs have clearly peaked. There is downside pressure to the ROA coming from lower margins. And also, obviously, we will discuss this a bit later on the ECL norms perspective, whereby there will be some upward bias in terms of provisions. And we've also seen off late in the results, which we will discuss later, some signs of stress emerging across the board, right? So, so clearly credit cost normalization is only going to gather a little bit more amount of steam in the coming quarters.
Okay. Before I come to this, credit cost and the fact that unsecured loans have shown stress,
Yes.
You wrote a note to that effect. Before that, Let me first finish off HDFC Bank. They also stunned the market with a fairly high-yielding deposit announcement. I think 1 to 3 years, they give you now 7.35, which,
Correct.
if HDFC Bank gives you that kind of money, others will have to, at least match. So what is the expectation from HDFC Bank itself? Are you toning down their margins? What's the opinion on that bank?
Yeah. So look, I think they are in a peculiar state in a way, or what has happened actually. Of course, if you look at it, Latha, if you look at the ALM pattern, they do have large amount of borrowings maturing by the end of this year. And if I were to really compare the borrowings, the 1 to 3 year bucket, and the deposits in the 1 to 3 year bucket, I think if they are able to garner deposits even at a slightly higher rate at about 7.4%, as we talked about, and the borrowings are coming in at 8%, or rather there are existing borrowings at 8%, it makes every sense to take those kind of deposits and replace the borrowings. And what exactly happens is they have an idiosyncratic issue which results in them actually having an ability to bring down their cost of funds, because their cost of funds is affected because of the merger. That's not the case with
Yes,
others.
yes.
So in that process, everybody else gets affected a little bit more negatively compared to HDFC Bank. And therefore, if you look at this quarter itself, well, everybody else faced margin pressures. Their margin did go up by 3 basis points. I know it's a small
Yes.
number, but at least directionally it was good, right? So that clearly goes to show, Latha, that they are in a different situation, and therefore I think they should be in a position to maintain, or in fact improve margins from current levels, and report that 14-15% earnings growth that we are talking about.
Okay. Okay, now let me come to that unsecured loans note that you wrote. Who are the biggest casualties and who are the winners?
Yeah, look, I think, Latha, let's understand that there is no casualty as such, because we have to understand that these portfolios are very granular. The risk is also concentrated in specific segments in the unsecured space. It's not across the board, all ticket sizes, certain pockets, certain geographies, and of course, certain stress on the credit cards portfolio. So what exactly happens here is that while there is going to be an uptick in the credit cost, it's going to be well within the manageable levels. The only problem here is what is getting priced in, right? So the first instance of some normalization levels of credit cost results in the markets getting a bit more jittery. I would still presume, even for that matter, PSUs we have seen, which has seen an increase in the personal loan delinquencies. Remember, for SBI, it is a very small, low-digit percentage of the overall portfolio. Same is the case with Bank of Baroda. So it doesn't move the needle in a very big way. But yes, the fact that you are running at 30-40 basis points of credit cost, even if you end up having 10-15 basis points additional credit cost, to that extent, it is negative on the ROA, earnings expectations, and of course, eventually ROE.
Okay. Well, banking stocks or the banking sector has been the underperformer of the market. So the market probably got it right.
Yeah.
They could see that banks are going to be in for margin pressure, for probably asset quality pressure, even if it is marginal, and of course, technology investment pressure. Given this, what would your ranking be of banks? Who will be able to stem the tide?
So to a great extent, if you look at the numbers here itself, the private sector banks are still generating, despite this kind of an outlook, anywhere between 15 to 16, 17% kind of an ROE. Let's take that range, right? So, and the valuations are still very comfortable at this point in time. So even if you assume there is no further aspect of re-rating from current levels, 15 to 17% ROE can itself result in that much amount of power of compounding over the course of next I would say 2-3 years. So I would still stick with private sector banks. Also, the argument is narrative is coming from the fact that, Latha, they are gaining market share on deposits. If you look at the deposit growth of both SBI and Bank of Baroda, it's been pretty weak in single digits. So clearly they're losing market share on that. There is a greater impact coming from ECL norms for the PSUs compared to the privates. The privates carry contingent buffers and provisions. So those are some of the advantages that the private sector bank has over PSU. So you're still sticking with the larger private sector banks at this point in time.
Okay. Let me quickly get the fintechs in and then come back to the banks if I have time. There are two fintechs you cover, 197 or Paytm and PB Fintech. Where are they in this whole picture? Are they better able to stem the tide of margins? Are they showing better business growth?
So definitely PB Fintech has been doing a better job in our view. Growth has been, of course, surprising us positively. continuously. In fact, over the course of last several quarters, they are gaining a greater market share in the segments that they're operating. One area where there has been a clear progress that has been seen is on the health insurance front, where very clearly growth levels continue to remain very strong. And they have a very small market share in the savings product segment. So coming off from a low base, they're doing pretty well. And interestingly, they've also been in a position to manage expenses and show operating leverage in their business. So in that sense, PB Fintech is, in our view, in a much better position. I still believe when it comes to 197, there are still a lot of pulls and pressures when it comes to the loan dispersal that they do. I still believe there's quite some time away before we actually start seeing reasonable amount of growth in that segment. And secondly, I'm still not very convinced on the regulatory and aspect, right? I mean, time and again, they have, of course, had these run-ins with the regulator, and therefore we need to get a little bit more amount of comfort before we actually begin to get constructive on that name.
Time completely, Suresh. One word on your best pick.
Oh, in the current environment, I'll still stick with the two largest private sector banks, which is HDFC Bank and ICICI Bank.
Okay. All right. Unfortunately, out of time. Thank you very much, Suresh, for rounding up both the macro pressures of Fed and RBI, as well as the regulatory rules and the earnings in a very short chat. That's the word from the banking analyst. We have to take a break and come back with Chartbusters.